We're going to get started here soon with How to Speak a Lender's Language, presented to us by Vancity Community Investment Bank. So if you're here for that, excellent. The Vancity Community Investment Bank is a sponsor of the conference. They've sponsored every summit we've ever had. They're a big ally to the movement as well as to many of our members. So we're super happy for them to come down and break down some of this tricky financing language for us. It looks like we have a spacious session today, so have your questions ready. It's just that end of day type of thing. So that's good though, because we're going to have more time for questions and discussion. So I want to welcome Byron. Thank you for coming to speak with us. I'll be in the room at the back, and yeah, thanks so much. Take it away.
Awesome, thank you, and good afternoon to everybody. If you were just in the Indigenous session, was so interesting to listen to and just to learn. I guess we're all immigrants in Canada, so the learning about the history is really, key to being a part of this community and this country. So that was really a good session. But let's talk about property finance. Let's talk about your next property acquisition or your next construction project. Let's see what we can do together. Like it was said, I work for Vancity Community Investment Bank, also known as VCIB. My name is Byron Eckersley, and I'm a senior manager focused on commercial real estate finance at VCIB. Our team and I look at social purpose real estate. That's specifically property that makes an impact in the communities in which we operate. I'll share more details on that with you in the slides that follow, but just following on from the last presentation, I just want to do, like everybody else has, land acknowledgement. I would like to acknowledge that we are gathering on the ancestral and unceded territory of the Mi'kmaq people. This acknowledgement also knows that this territory is covered by the treaties of peace and friendship signed by the Mi'kmaq, Maliseet, Passamaquoddy peoples, and Vancity is committed as a core value to reconciliation. The Mi'kmaq people have been here for many, many years, taking care and stewardship of the lands that we're on. And we recognize the enduring presence, and we pay our respects to the elders past and both present. So let's talk about Vancity and who we really are. So I work for Vancity, and I'm in the social purpose real estate team. We are Canada's only 100% impact bank. So we focus just on impact lending for our clients. VCIB is a wholly owned subsidiary of Vancity Savings Credit Union, which has a presence in British Columbia. We are Schedule 1 bank, which means we're alongside all the other large banks in Canada, RBC, Scotia Bank. We operate in the same level as them. We are based in Toronto with lending operations across Canada. We have most of our funding done in Ontario, but we're looking to grow our presence in both Nova Scotia and in Alberta. So we can operate across the entire country, lending for social impact financing. Every dollar we lend out has to have a measurable net positive impact on the communities that it goes to. We're a member of the Global Alliance for Banking and Values and a certified B Corp organization. We have commitments to net zero finance emissions by 2040. So we really focused on making an impact both, from an environmental point of view, as well as from an affordable housing point of view. Those are our key sort of focuses. Like I said earlier, I'm in the social purpose real estate team. We also have a climate finance team that focuses on green energy, wind power, solar power, and other very innovative ways of generating electricity, and other businesses where we can have an environmental impact. So social purpose real estate, what is it? Social purpose real estate is really affordable housing. It's co-ops, it's land trusts, it's heritage buildings, it's arts, culture, and community spaces. It's nonprofits. It's all those entities that struggle to find financing generally that we lend money to make acquisitions of property as well as to construct new property. So we provide financing for commercial real estate projects that drive social, economic, and environmental benefits in communities across Canada. Within social purpose real estate, we provide financing for all those entities I mentioned. We offer different types of funding, construction funding. So if you want to build a property, we can help you build a property by giving you debt financing. We offer term financing, that's for your acquisitions. If you want to buy a property, we can assist by providing the debt financing for the acquisition. We're also a CMHC approved lender. So what that means is we can get insured financing in place for you. We are approved by CMHC to do that. And we also have, bridge loans that we provide. It's called our Preserve and Protect line that a lot of, land trusts are actually using to preserve affordable residential accommodation in the market. I'll speak a bit more about that later. We serve and support those that create affordable, sustainable, and purpose-driven businesses. These include, like I said, nonprofits and charities, foundations, women businesses, co-ops, B Corps, and social enterprises. We have really partnered with so many land trusts over the years. We've partnered with Parkdale Land Trust, Circle Community Land Trust, Ottawa Community Land Trust, Kensington Market Community Land Trust, and the Union Cooperative. VCIB has partnered with the Canadian Network of Community Land Trusts that was mentioned earlier. We actually have a seat on the board of the CNCLT, and we are deeply involved with the organization. We also work quite closely with the Cooperative Housing Federation of Canada, CHF Canada, which is a valuable resource for assets and financial planning. After their consultations with potential clients, CHF Canada usually refers those co-ops or land trusts to us to provide financing. We also have a very close relationship with CMHC. 2 years ago, VCIB and CMHC announced a first-of-its-kind agreement to accelerate the delivery of affordable housing across Canada, providing finance to more than 1,100 units of affordable homes. VCIB's long-standing relationship with the CMHC enables us to work together to provide housing cooperatives and affordable housing developers with uniquely structured loans that meet their specific financing requirements. So what does it mean? What do you have to do, I guess, and why come and work with us? Why would you come to us and not go to another bank? I think is a question everyone would ask. And the key thing with us is that we have preferential rates and fees for nonprofits. So we're going to charge you a lot less money, to get your loan put in place and to do the assessments. That's one of the key things that we offer. Aligned with that is that we only want to really do impact lending. So, the match of the sort of objectives and goals is very closely aligned between ourselves and, land trusts. We do preferred loan structures and policies. One of the key things that we do is we offer a 1x debt service cover ratio. So if I can unpack that for you, debt service cover ratio is really assessing your ability to pay your interest and capital on your mortgage payment every single month. Now, a 1x debt service cover ratio is something that other banks don't do. It's very unheard of because what it means is that there's no excess cash flow in your business. Now, nonprofits are really that. They're not for profit. They're not supposed to be making one, right? So we understand that, and we understand the complexities of the structuring and the business so that we can actually put in place this financing that meets the structural requirements and the ability of the land trusts and the co-ops. So it's a very unique offering that we have for nonprofits, and it's just for nonprofits that we do that. So that's a very big draw card for our borrowers. We are deeply engaged in affordable housing in Ontario and across the country, like I mentioned, and this is our mandate to chase. So that's what we want to do. We don't want to do for profit necessarily. we are focused on affordable housing. The preservation and development of affordable housing are our key focus. I've mentioned the preserve and protect line, and we've used it a few times with land trusts. It provides bridging finance to preserve the properties that are on the market. So, say for instance, there's an affordable building that's up for sale currently, and it's going to be a for-profit buyer that's coming in. He's going to renovate. He's going to get the people out. It's no longer going to be affordable. It's going to lose that affordable nature. We provide this preserve and protect line to allow nonprofits, land trusts to make that acquisition when there's a tight time span between the transaction starts and finish. Because sometimes these transactions can be very quick. And the ability for us to get the CMHC financing that you might need for this transaction is going to take months. You know, CMHC is not the fastest organization. So we can give you a 1-year preserve and protect line to help you bridge that gap between the acquisition and the financing. And lots of land trusts have used that over time. The lending for the preserve and protect line is usually at prime plus a spread, and it would be interest only. And it's usually for a 12-month period, like I said, to bridge the time gap between the transaction and CMHC financing getting put in place. And it's really structured according to the borrower's financial situation. We go very high on the loan to value ratio on that. So we can go up to 125%. So we can lend sometimes more than the value of the property, which is very aggressive, right? But we make that consideration for land trusts and nonprofits. So it's a very special project or product. If you're looking at buying a property that's come up for sale, your scares can be taken out of the affordable markets, and we really don't want that. Speak to us and we can help perhaps preserve that affordable property. Moving on to, I guess, you know, the benefits of working with VCIB. Because I spoke to most of those already. So I'll just jump to the next slide. Sorry about that. Just on the actual process to get finance with us, how does that work? So you found a property, you know, it might be in your community, and you want to now purchase that property. You want to preserve it. You would come to us with the details of the property, and we would do initial assessment to see, you know, what is the property's condition, for instance. What are the sort of structures? What's the pricing on this debt that you'll need to make the acquisition? This is all part of the pre-assessment process. So it's a very high level initial assessment of the property that we'll look at. And then we submit that to our credit department to assess the risk of the property as well as the pricing, just to make sure everything's tying up. If credit gives it the approval, we will issue a letter of interest. So letter of interest is really a discussion document for us to assess, you know, the terms and conditions of a potential lend with you and whether you're comfortable with those terms and conditions. So it's not a really firm commitment, it's sort of an initial discussion paper. You would then, if you're happy with those terms and conditions, sign back the document, send it to us, and you'd pay a very small application fee. From then, we would ask for a lot more deeper detail on the property. We go through a very deep underwriting process. We do a lot of due diligence on the property. We do a due diligence on the borrower, and we assess, you know, all the risks of the property and whether it will pencil out for our credit team, because they really make the final decision on whether we lend to you or not. That's what my team currently does, and then we submit the full credit application to our credit team to review. They'll review the detailed documents and make an assessment on whether it's a go or not. And once we get that confirmation, we'll issue a formal commitment letter to you that states all the terms and conditions that need to be met for the transaction to complete. We usually have a list of conditions precedent to the money being funded that will state, you know, what security you need to have in place for the loan to be completed. You know, what other documentation we need to see to be comfortable to proceed. So once you've signed the commitment letter, you've paid the commitment fee, which is also reduced for land trusts and nonprofits. We would then go through the funding process of collecting the conditions precedent, engaging with the solicitor to make sure that, you know, we can get all the security documents put in place. and just finalizing all the agreements and making sure that on the acquisition date the money can flow. The money must flow, because when you buy property, it's a very hard date. There's no wiggle room. Usually the sales agreement will say the transactions are specific dates. We would line up everything to make sure on that date we can transact. So my team will go through all that, work with you to get the documentation, get everything in place. Our lawyer will talk to your lawyer, ensure the security documents are put in place, and then hopefully on the transaction dates, on dates of closing, everything lines up and the monies flow and the property becomes yours. That's the goal that we're aiming for. I guess after that, then it's sort of business as usual. You'll hear from us, I guess, monthly via sort of, statements to say this is how much you need to pay. But it will really be low engagement for a while. Unless you need something from us, we're always available. You'll have a dedicated account manager who will engage with you on your particular property and your financing to make sure that everything's going well. So we have that very personal relationship. I think that's also one of the key differences between ourselves and the big banks, is that we manage and maintain very close relationships with our borrowers. I was actually speaking to a land trust at the party on Thursday, and they were saying their experience with us was so good in the sense that they had assessed an opportunity, but they didn't have the expertise in putting together the pro forma document, the income statement, the balance sheet. They couldn't do all of that. They didn't have an in-house accountant, I guess, and we helped them do that. So it was even before the application phase. We assisted them by giving them advice and guidance on what was required, to actually move to that pre-assessment stage of the financing. So even before that. So we really, like I said, focused on impact. Impact is our priority, and we will help where we can, as much as we can, to get that financing done so we can provide more financing for affordable housing in Canada. I guess other than that, we do an annual review of your loan. So once a year exercise, where we just ask you for some documentation specific to the performance of the property. We look at the security to make sure there's no further debts on the property. We'll just review the board to make sure there's no board member changes, no risks, no significant risks have changed. This is done on an annual basis, and it's really part of our ongoing monitoring of the loan and our view of the borrower, and part of our risk management of the loan portfolio. So nothing to worry about right there. It's just an annual exercise, and it's also required by regulatory laws that we do this every year. Then the last sort of example of engagement that happens on maturity of your facility. So upfront, we'll offer you a 3 to 5 year loan. The 3 years or 5 years has passed, and now we need to engage on renewing that loan. We would reach out to you on maturity of the loan to make sure that we're able to renew it for you. So we'd reassess the property. We'd do a new application to credit to assess the property, the risks, whether we're still comfortable with the loan. We look at your interest rate and see it could potentially go lower. If the Government of Canada bonds have dropped, it could be a lower interest rate for you. Hopefully not higher, it goes up sometimes, not very often, but hopefully we could offer you a lower interest rate. Your property is going to be somewhat deleveraged in the sense that you've paid down on some of the debts, right? But your property value stayed the same. So the loan will in essence be less risky for us. So it's best to stay with us then, because we understand the loan, we understand the property, and we can offer you even more competitive pricing than you would get going to another bank. So that's sort of the key stuff that happens on the renewals, that it's every 3 to 5 years, depending on the term of the loan. Just moving on from that. So part of the whole process I've spoken about now involves a lot of documentation. And I just want to give you some flavor on what we'd look at in the sort of, I call it 4 buckets of information and why we need that information. So I guess the first one's the financial statements, right? So you as a land trust should have financial statements, okay, that will display your income statement and your balance sheet and your cash flow. So we would look at that balance sheet, income statement and expense, and your annual budget, just to assess how you're doing financially. Like how's the cash flow looking? what's the asset value looking like, what liabilities you have on balance sheet, what expenses are you incurring, what's your reserve funds like, you're putting enough money aside for that. So that's very important in the process of analyzing whether we can lend money to you. It's probably the first thing we actually do right up front at the pre-assessment stage, and then also later during the deep due diligence. With regards to the borrower and guarantor, it's really looking at who are we doing business with, who are the people that we're doing business with, who are the board of directors on your land trust, right? What are their CVs like? Why are they even there? Like, are they part of the community? Have they ever vested interest? Is this something they're passionate about? Those are the kinds of stuff we really want to touch on. We look at the management experience as well. If there's a management team there, and sources of equity. Now, I know I've been speaking to so many people about equity. There's no equity, they say, in land trust. We don't have equity. And equity is really just the cash you source to put into the deal upfront. A lot of the time, I guess with land trust, you can do community bonds, right? That would be a source of, let's call it equity for you, because the community bonds will be sort of below the debts we provide you. The debt will sit on top, and then you'd have community bonds coming in below. I guess in that bucket for land trust, you'd also find donations. And I've seen quite a few donations coming from very different sources, right? You get anonymous donors, you get city donations, Vancity Community Foundation. So we have a foundation in our group that actually makes donations as well. And they've given some money to some projects to make them work. That's a full-on donation. So we work together on these projects to make sure they happen. That's our deep commitment to affordable housing. Moving on to the actual property now, I guess for us, that's one of the most important pieces, because when we assess the loan, we want to make sure the property's value and its ability to earn income is sufficient for, one, to maintain the property so that people can live there, in decent accommodation. And that's through payments of taxes, payments of repairs and maintenance, salaries, and other expenses that are incurred in maintaining the property. So we look at the rent roll to assess the income, and that's basically a list of all your tenants and how much rent they pay. Through that, we can also assess how much vacancy there is. Now, the beauty with land trusts and affordable housing is there's so much demand, right? And we hardly get a situation where we have a lot of vacancy. It's very rare, right? And the beauty as well is that I've seen in Toronto, a lot of the time, the city gives you lots of grants. There's rent geared to income sort of systems where they can top you up, and it helps your income with regards to performance and meeting your expenses. So we look at their property statements, we look at the rent roll to assess your performance from a financial point of view. And then if there's any other additional information that's needed. So this is really for existing properties. And I've heard a lot of, the talks that land trusts are really trying to preserve, property and not construct new. That's what I've heard over the last few days. And I guess the difficulty is that in construction, it's a lot more expensive, right? So I guess deals of the property there, if it was construction, we'd look at a bit more. But I guess for this purpose, I don't need to go into that detail. And then I guess the sort of final bucket is your third-party reports. Now, those are reports that are tied into the property. Your building condition report is really just that. What is the condition of the building, right? So it looks at, what's your condition of your roof? What is the condition of your boiler? What's the condition of your elevator? What's the condition of the ventilation, the HVAC system, all the nuts and bolts of their property, and how are they working? What's their sort of useful life, and what sort of major expenses are coming up soon for their property to continue to operate effectively and efficiently? So we would do that assessment to make sure that, you've got sufficient reserves in place to meet those expenses when they happen. And also, just it's a risk measure to see that we're not funding a building that's going to fall apart tomorrow, kind of thing, So that's the key thing with the BCA. The appraisal, that's just a valuation. It gives us a sense of the value of the property. It tells us, this is what it would sell for instance, if we had to trade it. And I know with land trusts, you're not ever looking to sell, right? But we need to assess that, just to get a view on one of the covenants, which is the loan to value covenants, right? So if your property is $1 million and we lend you $500,000, that's a 50% loan to value. We've lent you 50% against the value. So that's where the appraisal is critical. The appraisal is critical. It tells us what the estimate of value is. And it's got a lot of other useful information in regarding, where the property is located, when it was acquired, a lot of useful details included there as well, for our sort of reading and understanding. The last one of those third-party reports is the environmental report. Environmental report is very important. It talks to the environmental conditions around the property. Okay, so it can speak to air quality, it can speak to the soil quality, it can speak to water quality. It's very important for us to have a look at that, specific to where the property is located. So if you're surrounded by a light industrial property, there's a high chance that there could be pollutants, right, that have gone into the soil and now in your water, or there could be issues with your air quality. So the environmental report is really going to take us through all those specific environmental risks. And a lot of the time, there's a phase 1 report, that's initial assessments, and if there's problems picked up, they do a phase 2. It's not the end of the world, though, because a lot of the time we can remediate those issues. There's a way of fixing them, okay? You'll have to, get the soil processed, take out the pollutants. So there's a lot of work that can be done to mitigate any identified risks with the environmental report. Okay, so moving on from there, I'm just going to give you a bit of flavor on some of the other products that we actually have. Besides lending products, we have deposits. So we take deposits for if you have excess cash in your business or in your land trust. This first one is called the Affordable Housing High Interest Savings Account. And it's various special products we offer to non-profit housing providers. The posted rate there is at 3.1%, and that's very competitive with what the big banks offer as well. It's not tied to any borrowing, so you don't have to borrow money to get the deposit. You can just do the deposit on its own, this deposit offering. And it can be used to house any excess cash, like I said, you might have. Another product that we have is the Impact Guaranteed Investment Certificate. This product gives organizations the ability to support transformational work in their communities. So, you can put your money with any bank, but you don't know where the money is going, what the purpose of the money is going to be used for. Here we are getting this money from you that we'll hold in our accounts. We'll pay you interest at a very favorable rate, but we're going to use that money to on lend, for affordable housing, or it's going to be for clean energy projects. When you invest with the Impact GIG, your deposit provides growth capital for purpose-driven businesses and helps finance impactful projects in Canada, like I said, clean energy and affordable housing. Just as an example, with our deposit products, we managed to get some funds, and our clean energy team supported the Six Nations of the Grand River Development Corporation, their clean energy portfolio with investment there. So that was quite impactful. On our affordable housing side, we have a very long-standing relationship with Habitat Canada. So we've provided them with a $30 million credit facility to build affordable housing for ownership. And we've got multiple projects across the country that we've invested in. So the money you put in the gig is going to those causes. So it's really, if you really truly live by your impact mindset, this is where you should be putting your money. The Impact Gig is a low-risk investment that offers both non-redeemable and cashable options for short-term and long-term horizons. The fixed terms are from 30 days to 5 years, and there's cashable 1-year terms. The minimum is a $50,000 deposit, and these products are insured by CDIC. The rates are very competitive. Like with our borrowing or lending products, you'll have a dedicated account manager, and we charge no extra fees for this. So it's really beneficial for you. Okay, let's get on to the really exciting stuff. Now I can give you some examples of where we've actually done projects with land trusts. and how we've made an impact. I'm sure everybody's heard about the Kensington Market Land Trust deal they just did in June of this year. We provided a significant amount of debt financing for that. The asset that they acquired is a 5-story mixed-use building comprising of 26 affordable residential apartment units and 11 commercial units. The property also includes a large rear parking lot with access to Kensington Avenue, offering potential for future development of additional affordable residential units. All units of the property are at an affordable rental rate less than 76% of the average market rental. The acquisition was supported by VCIB's first mortgage, so we gave them a loan. The City of Toronto also provided Mura funding. Okay, Mura funding is a very interesting funding that the City of Toronto provides. They give you this money and they also take away your property tax. So you don't pay property tax. It's really, and I think we heard earlier in one of the sessions I was in the tax session, I think earlier next door, and they're talking about property tax and that this is one of those opportunities where you can not have to pay property tax forever. You know, it's pretty impactful on your income and your ability to, you know, maintain your property. So City of Toronto's Mura funding came in. We had an anonymous donor that I think put $3 million or something into the property as well. It was quite significant. And then also the Vancity Community Foundation made a donation here to make this project happen. So it was really a collaboration. I remember working to this deal and it was a lot back and forth and we were trying to get everybody on board. We had to wait for documents from the city. And so it was really like a team effort to, you know, like I said, with acquisitions, there's a date, say there's no missing that date. So we got it done by that date. And Kensington Market Community Land Trust managed to acquire that property. And in the process, secured affordable units for the community. Now, this case was, you know, too, I guess, out of the box for CMHC. So they would have liked CMHC funding here, which is cheap financing, but there's a significant portion of commercial space in this property. CMHC doesn't like to be in commercial property. It's not one of their, you know, mandates. And the specific requirement from the CMHC is that the gross floor space of the commercial units must not exceed 30% of the total sort of lending value for the property. So yeah, CMHC, like I said, does not typically provide insurance for non-residential or commercial uses. If they do accept it, then the non-residential component can't exceed 30%. And a key challenge on this project was that the commercial piece was a key issue. And the issue there was that there was a departure of an anchor commercial tenant in the process of us going to this funding. So they lost a huge commercial tenant. And that obviously impacted the ability to pay their debts, you know, the monthly mortgage on the property. So we didn't stop the transaction from happening, even though there was this risk. We looked at the risk, we assessed what the shortfall in cash would be, and we did a reserve. So we lent the money on, but we held some back, right? With the undertaking that they would find a new commercial tenant for that space in a number of months. We were comfortable with that because we've been trying to do a deal with Kensington Community Land Trust for a long time. I think this is their third transaction. And they've proven they know what they're doing. You know, they've proven that they can lease up commercial space. They've done it. So we were confident that the risk is there, but we were confident they could actually get that space let or leased. So we went ahead and it's still in the process now of you know, being leased. But the reserve that we held back has been placed in one of those products I mentioned earlier. So it's earning interest until the vacant unit is leased. Once that vacant unit is leased, we will release the money to the land trust. This structure really enabled the borrower to close on the transaction, also earn interest on the reserve, and secure the necessary time to lease up the vacant space. So we've worked with them, and that's what we do. We work with land trusts all the way to make these transactions happen. An additional issue that we faced was just with the MURA funding from the Toronto City. They made a change recently where you need to get affordable rentals from day one. So the day we fund the units or the property, they've got to be at a specific rental, affordable rental. Whereas in the past, they allowed you to sort of ramp up to that affordable rental over time as you had tenants leaving. And that had an impact on the income as well for the property. So fortunately, we managed to pencil out all the details there and the project went ahead. Um, and like I mentioned earlier, we put that 1 times debt service cover ratio covenants that other banks don't offer. That's where it came in. So we gave Kensington Land Trust the 1 times debt service cover ratio because their income was under pressure. The transaction still went ahead. So that was a positive. So that's Kensington. And I want to speak about Ottawa. I see Patrick's in the house as well. And yeah, so Ottawa Community Land Trust. We've dealt with them over the years, and they've purchased quite a few affordable residential properties. In October 2023, the OCLT, I'll call them, purchased an at-risk affordable residential building with 6 units in Kirkwood Avenue to protect Ottawa's affordable rental stock. It was a very old property that had been constructed in 1955 and was 2 stories with 6 units of multi-family apartments. All the units were affordable at 70% of the average market rent. We worked very closely with the City of Ottawa on this one as well, just to ensure that the process went through smoothly. So this collaboration we're doing all the time, with the city, CMHC, we're really getting involved. We get involved. We on calls with the city. We help our clients. We help the borrowers. We help land trusts get these transactions done. Another transaction we did with the OCLT was in October 2024, where they acquired their second property, 366 Brand Street, Ottawa, Ontario. The property was constructed in 1950 and is improved with a 2.5-story, 10-unit multi-family apartment building. All units of the property are an affordable rental at less than 80% of the average market rent. So with both these transactions, it's been a challenge for them to get that equity I spoke about, that cash, right, up front. And we used here the preserve and protect line that I spoke about earlier. That line of credit we give you so you can actually make that acquisition while you wait for CMHC or while you wait for your community bonds or some other source of cash to come in. It's a temporary thing that we can convert into term or can be paid out by community bonds or other sources of cash. So yeah, they've managed to close on those 2 transactions, and I think they were successful in raising community bonds and were able to pay us back the money that we had lent. So they did well. And all you need is time sometimes, right? You just need time. I mean, the property is going to get sold. And if you can't act, somebody else is going to take it and then it's not affordable anymore. So we allow you that time to get your house in order, get that cash together, and then you can do the transaction. Just moving on to, I haven't moved it along, sorry. Moving on to the sort of economic and CMHC updates, as well as grant opportunities and other sort of avenues that one can look at. I want to just paint the picture, the landscape, and then perhaps opportunities for land trusts and how you can grab hold of opportunities that may exist in the current markets. So Bank of Canada is currently holding interest rates quite flat, right, at 2.75%. And I guess the forecast is going to stay pretty stable for the next 12 months. GDP growth has cooled a lot after the tariff debacle we had beginning of the year with the US, where people did a lot of sort of purchasing before the tariffs came into place. So GDP went up a bit then, but it's sort of tapered down now. And unfortunately, unemployment has now gone up slightly. I think last month is slightly over 7%. It used to be hovering around 6.9. So there's a bit of an impact on unemployment that's happened in the last month or two. And then Inflation, fortunately, is hovering at 1.7, which is good. But what does this actually mean? The picture's really not rosy, right? I guess one of the sort of bright spots for housing providers is that inflation has slowed. That's a positive. And that's favorable for construction as well now, because we've got the interest rate is way lower than it was, 18, 24 months ago. So the cost of building has come down from a financing point of view. And there is room for reduction in interest going forward as well. I guess on just the supply of rental accommodation and affordable accommodation as well. There's so much new supply coming online, specifically in Toronto. You see tons of buildings that are nearing completion or have completed. And I mean, yeah, in Halifax as well, just driving in from the airport, I could count quite a few high-rise buildings at various stages of completion, right? So there's a lot of stock still coming that was approved years back. I know that new construction is really cool. We're back at about 20 years, 30 years. I don't know how long ago the number of new starts for construction is really cool, but we've still got this legacy of the last few years coming through. So supply is going to continue to increase. And I guess we're going to have increase in vacancies, right? Because there'll be more units that are required, that are available, that are required, which is a positive. That's going to drive down rentals, right? Because there's more supply, less demand, rentals will come down. And this is a good thing for the average Canadian. But the devil's really in the detail. And the problem is that family-sized units haven't seen much relief. So if you're looking at a 3-bedroom unit, for a family, those rentals haven't really come down. And overall, rentals are up significantly in the last 5 years. I mean, from 2020 to now, the rental increase since then, it's been phenomenal, right? And it hasn't come down. It's not going to come down materially. So the need, I guess, and this is the gap here. The need for affordable housing continues. Affordable housing is always going to be in demand. So that's a positive in the sense that we can take action and do more affordable housing and preservation of affordable housing. Just on the tariffs, I'm going to be quite short on the tariffs, but we've heard all about the tariffs, I guess, and Canada's sort of been yo-yoing back and forth. There's tariffs, there's no tariffs. We don't know what we're doing, kind of thing. But I'm not going to get into that. But the bad news is that there's tariffs now, and it's going to be bad for our economy. That's just the bad news. Um, I guess just on the sort of grant opportunities and new government proposals, federal financing remains the backbone, right? So CMHC is really driving the construction of new residential purpose-built accommodation in Canada. I was speaking to Jeremy, he was outside at the CMHC table just yesterday, and he showed me a graph of the insured products that they're doing. It's 88% of new residential development for rental, 88% of it is actually CMHC insured. So if we didn't have CMHC, the market would have really dried up. So they've really, held that together and been able to provide that insured financing to allow projects to actually continue and for new projects to start. And a lot of developers that were looking to sell are pivoting now towards rental because the sales market is completely dried up on the condo side. So CMHC is still the go-to, and I think something to keep in mind if you're looking at doing acquisition, keep that in mind. On the various non-CMHC options, the landscape is wide, and difficult to navigate. What we do know is that the government is speaking clearly about its commitment to making more housing affordable. So we've heard that, right? There's apparently lots of money, but we don't know how much. So we're waiting to hear. Hopefully soon we'll get that information. The Canada Housing Infrastructure Fund has allocated $1 billion for direct lending and $5 billion to allocated provinces, territories, municipalities, and Indigenous communities. So there is some funding that's been allocated. Hopefully that can roll out into actual property development. Build Canada Homes, which is a Crown developer, has been announced, and consultations are ongoing with industry. The estimate is that they're going to provide $6 billion toward deeply affordable housing. So Yeah, we're expecting the stuff to happen, right? We've been told about it, but hopefully it's coming soon. I guess overall theme is that, there's a cooperation amongst various government departments. And if you put all these sort of programs and opportunities together, there's really, commitments and they complement one another. So there's an opportunity that when these things come to the forefront, we'll be able to implement and actually bring on more affordable housing. I'm not going to go to CMHC in too much detail, other than to say that, the MLI Select product remains very key in the development and preservation of affordable housing. There's various scoring metrics. I'm not going to take you through all of that, but it all depends really on how much affordable units you have in your developments. The more affordable units you have, the more points you get, and the better terms you'll have with your insured mortgage. Based on those points, you can benefit up to a 95% loan to value and up to a 50-year amortization. So it's really favorable for you on your debt serviceability. CMHC has also announced some major changes that took place in July of this year. The one was that they have this rental achievement holdback. It's for construction loans. They expect you to hold back some money until you achieve the forecast rentals on the property when it's completed. So they were requesting a lot of the loans before July to put down a sort of holdback of 25%. So developers had to put in 25% of their own money into the project upfront and only get that back when those properties rather reach their rental forecast. So people were unhappy, but they've taken that away now. They've reduced that holdback and it's making projects more feasible. Just on the premium side, you pay your CMHC premium on the market rental and MLI Select products. Those have gone up. There's been some changes to the premiums. So that's something to keep in mind, that the cost of doing a CMHC loan now is not what it was, before the 14th of July. So I guess having just gone to the landscape, where are the opportunities for land trusts? Where do I see those opportunities? I was listening to, I think it's Josh from Parkdale Community Land Trust. He raised a very interesting point in one of the sessions. He said that with the rentals now cooling, the corporations that bought the buildings, the old buildings of affordable housing, are now not getting the expected returns because the rentals are not going up, right? And apparently some of them want to offload the properties back. They want to sell them. So there's an opportunity there to actually take back some of the properties that were lost to corporations, which is really, I think, something that you must keep in mind in your communities. If there are properties that are owned by corporate landlords, their shareholders are not happy, the returns are bad, they made a bad decision, they overpaid for the property, you could get a good deal. That's it in a nutshell. So keep your eyes open, ears to the ground, and just see what's happening in your community. And if these opportunities come up, contact us and we can see if we can help you in buying those back into your community. So that's definitely, I think, a gap that exists currently, and that's going to probably get more in the future. So don't forget about that. I guess the other sort of key item that remains is CMHC. Like I've mentioned, they're still very much focused on providing very favorable insured facilities to land trusts, and we've done a few. So, we can help with that. And then again, just to reemphasize, we have the preserve and protect line that can address urgent acquisitions that are going to happen that you want to, jump on and keep to yourself in your community. So yeah, I guess, those are the key sort of items. That's it for me. Thank you for joining me. This is the last sessions of this conference, I think, at this time. Thank you for coming to listen to me today. And my details are up on the screen. I'd love to hear from you. Me and my team are keen to work with you in preserving affordable housing and constructing affordable housing in the market. So thank you. I'm good if anybody's got any questions you'd like to ask. Yes.
need to these drawings, engineering drawings, and doing all the site work that's required. Oh, do I need to start again, or did everyone hear? I see thumbs up. So I'm just curious. One thing I wasn't clear on is, does your scope kind of cover that aspect of the financing, bridge financing specifically? So after early stage redevelopment, prior to when you have a building permit and you can access your COIs, et cetera, for more typical construction lending.
So we wouldn't necessarily lend depending on what stage you're at in that process, right? So if you've got the land, right, you own the land, okay, that's a good thing. We're happy with that. Will give us one step forward. You've got you're working on your permits, building plan, you got your site developments in process. I guess we can look at those situations and assess whether we can lend. It's not a no from us. But we also have the community foundation that can perhaps step in there and provide some funding, donation funding. So just depending on how impactful the transaction is, how impactful the property developing is, that might be an option as well. So I'd say we could assess you for normal debt financing, depending on where you are in that process. And then there's also the foundation that could perhaps, lend you some money as a donation. Yeah.
Hi, this is potentially, I'm Edith, I'm from Hamilton. This is potentially a stupid question, but I know that most banks don't lend money to buy land. And I've often seen that as kind of like a real barrier, because obviously as a land trust, like some of the land that we can acquire doesn't have buildings on it yet. And I'm wondering if you guys are at a point where you would consider giving a mortgage for just the land without any buildings on it.
So we do have some land loans on our books, right? From a few years ago, the market for land loans has literally dried up. Banks are not really very excited about land loans now. The reason for that is land values, and I was in the land presentation next door. They were showing this graph about land values and how they've gone crazy. It's shot up, I don't know how much percent, but one of the biggest input costs for any property is the land value. Now, with this boom in construction, land values went up, right? And banks were lending against those land values, but now the land values have come down because development stopped, right? And there's all this land that people own, they're trying to offload it. So, in a nutshell, we do look at land loans. We're very sensitive to the loan to value. Okay. So 50% loan to value is probably as high as we'd go on loans that have land as a security, just because they land, there's nothing there. So it doesn't have income coming from it. It may be very early in the development stage, so it doesn't have approvals. So 50% is probably the maximum loan to value, but we do look at land loans, yes. Yeah. Okay, great. I guess if there's no more questions, I'll give you the gift of time and enjoy, I guess, the rest of your time in Halifax. Yeah.